I think that's quite likely part of a future negotiation or a future deal.
U.S. Energy Secretary Chris Wright speaking to Bloomberg's Jonathan Farrow and Anne-Marie Hordern. We have more ahead on the Asia trade. This is Bloomberg.
Bloomberg launches our inaugural 25 African startups to watch list.
About 2.5 years ago, we created a solution. We are able to generate refrigeration using the sun and water. We're able to store energy in the form of ice, as opposed to storing energy in the form of lithium batteries. We're integrated in every refrigerator a pay-as-you-go technology, allowing individuals and small businesses to be able to pay as low as $10 to own a refrigerator.
Uncover is a women's wellness brand that is specifically made for women of color. It's based in Africa, which is the most underserved beauty market in the world. We are making Africa a priority and not an afterthought. We believe that the population on this continent deserves to be formulated for, heard, and we are giving this consumer a voice.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
This is the Asia Trade. The latest from the corporate front. Ford CEO Jim Farley says the automaker had to idle its factories in the U.S. for the past 3 weeks due to a shortage of high-powered magnets. Farley says this shows the need for domestic supply chain as U.S.-China tensions restrict supply of rare earth elements. The magnets are critical to seats, windshield wipers, doors, and audio systems. Former Hong Kong Stock Exchange Chief Charles Lee plans to list his new fund, MicroConnect, on the bourse this year. If successful, it would mark the city's first investment fund IPO in nearly 15 years. The fund aims to support small businesses across China, Southeast Asia, Latin America, and the U.S. Meanwhile, HKX seeing a wave of weekend IPO filings from biotech firms Bliss Bio and Hangzhou Daigens to hotel giant Jinjiang.
Take a look at how we're shaping up when it comes to US futures right now. We're seeing quite a bit of sort of muted optimism, if you will, about the 0.75 or about 0.4% higher when it comes to US futures at the mill, despite these concerns that the trade deals might fall short of expectations.
Geopolitical news whenever and wherever it happens. I'm Jumana Versace in Doha, Qatar, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily. Every business day at 2 p.m. Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
Take a look at what we're watching when it comes to the commodities complex at the moment, and this as we continue to monitor sort of the muted developments in the Middle East, right? Winding back really that risk premium before now an OPEC Plus meeting is that next point of focus. We're seeing Brent really pulling back 0.8% softer there. We're also seeing some downside when it comes to havens, like gold off by 0.2%. But when it comes to oil, we saw that biggest weekly loss in more than 2 years. Hedge funds bearish bets following that fragile truce being struck between Iran and Israel. We're set to see OPEC Plus considering another 411,000 barrel a day increase for August. They meet on Sunday. That would be the fourth month of a bumper hike. So crude at the moment pretty close to where it started before the first attack by Israel on Iran on June 13th. So we're looking back to the fundamentals of supply and demand. We're also watching iron ore ahead of those China PMI gauges out later today. Well, the trade war, all of this has had an impact when it comes to Australia's forecast for commodity export earnings as prices dip, demand softens amid rising trade tensions. Bloomberg's Paul Allen joins us now with more. The uncertainty when it comes to China's trade, China's domestic growth situation, how's it playing out when it comes to the outlook for, you know, the drivers of Australia's wealth, typically, stuff that we dig out of the ground?
Yeah, not terribly encouraging. The Department of Industry, Science and Resources puts out a quarterly report. The latest one, even more bleak than the one that preceded it. Total resource and energy export down 7% in the year to June. That's dollar terms about $18 billion. So that brings it down to an estimated $252 billion US. And then if you break it down by particular commodities, iron ore, which is Australia's largest export commodity, most of it goes to China, the biggest customer. Well, it was already suffering from weak demand due to China's property difficulties, and the tariff battle with the United States hasn't really helped either. The body of the report deals with that specifically, saying, look, businesses and consumers are just adopting a wait-and-see approach when it comes to not just iron ore, but a lot of other commodities as well. And the outlook's not great either. That's expected to keep going, that trend, over the next couple of years. Demand keeps slipping, although faster than in the previous report 3 months ago. LNG, Australia's second biggest export. There's new supply coming on from the US and Qatar. So that's going to see another $21 billion decline over the next 2 years.
A whole different picture when it comes to the price of gold that's been steadily rising, right? Is that going to soften the blow when it comes to Australia's commodities exports?
Yeah, to some degree, 3,200 an ounce. I mean, we're off record highs, but still not far from them. And if you put that into Aussie dollars, the gold price is still above 5,000 an ounce. So if these prices hold, gold is going to soon overtake metallurgical coal as Australia's third biggest export earner, and that's behind LNG and iron ore. Also offsetting the price of copper, lithium, which are holding up and have a fairly promising outlook due to the transition to new energy and the long-term demand around that as well. Australia is blessed to some degree in that, in terms of its resources and minerals base, it's pretty much got it all. It's got the rare earths, copper, iron ore, anything you can think of, including uranium as well. So it's diverse. The resource minister notes this as well and says Australia is going to remain competitive, but certainly from a government perspective, it's going to make budget time a bit more exciting.
Thanks, Paul Allen there. Take a look at watching when it comes to the start of trading this week, with markets coming online in about 25 minutes or so here in Australia, as well as watching Japanese stocks as well. We've already seen US futures kind of ticking along to the upside. We're seeing a little bit of muted upside for Aussie futures there, and Nikkei futures us trading at 0.9%. US stocks on Friday rising to that fresh all-time high for the first time since about February. So there's quite a bit of conviction when it comes to the resilience of the US economy, despite these ongoing trade talks, which is a bit of a mix in sentiment given the concerns that it may sort of fall short of some of the details that markets might want. And institutional investors we've spoken to appear cautious about stocks in the second half, citing risks such as the tariff deadline, mixed earnings outlooks, US-China tensions. Let's get more from Garf Reynolds, who leads our Markets Live Asia coverage. The reality is that there's plenty of uncertainties, right? Whether you're looking at sort of bread and butter fundamentals as we get back to earnings, the macroeconomic risk, trade, geopolitics, the markets seem to be kind of muddling along and quite happy to see the upside.
Yeah, well, there are certainly some corners of the market that are very much doing that, and I think you can't underestimate the impact that retail investors are still having. You also, I think when you were giving that rundown of risks and thinking, well, the market's kind of lived through the ultimate play out of risks when it comes to tariffs, with the reciprocal tariffs, April 2 Liberation Day, and all the shock that caused. And the stock market has more than come back from that particular decline that followed after that. So in that scenario, there's an unwillingness to bet against US equities, given that they have come roaring back time and time again. We had similar meltdowns back in early 2023 with the regional banking crisis. We had the concerns in late 2023 when the UK problems set off the bond markets. Then we've had other incidences that caused similar angst levels, and yet here we are again looking at equities at a record high. The biggest concern probably is that valuations are looking stretched. We're above 22 times forward earnings for the S&P 500. That's the sort of level only seen, well, in the last year or so it's been seen on occasions. Before that, we got it in the post-pandemic boom when there was all the stimulus around, and back around 2000 when the dot-com bubble was, by that stage it burst, things were coming down. But that's the sort of levels that were achieved also in the run-up to it. So that's signalling good reason to be apprehensive that things could go pear-shaped from here. But at the same time, as I said, a lot of people have missed out if they didn't buy the dip. Buying the dip has proved to be such a good strategy that investors are unwilling to let it go.
Is that apprehension something that we're seeing in the bond markets as well? And what's the trajectory from here, given that, of course, we're still kind of uncertain what the Federal Reserve will do?
Yeah, well, I mean, the bond market is back in one of those scenarios it's been in a few times over the last couple of years, where it's very strongly expecting the Fed will cut rates. Not in July. That seems unlikely unless we get a really shocking jobs report on July 3rd. But it does expect the Fed will move to cut in September, and then at least once more this year, and that's going to be enough for the bond market to do well. And the bond market, to some extent, is also buoyed, I think, by it's actually had almost as good a first half as the stock market. For a while there, it was doing better, and it's been much steadier. So it has, in fact, delivered exactly what you would want to see from the bond market, which was, a nice, gradual, rise in returns, a haven from the volatility that was hitting the equity market ultimately, even though, of course, famously we had the slight moment of yippiness that President Trump reacted to in April. So, the bond market is keeping its eyes very much on the prize of Fed rate cuts, and again, learning to live with, learning to look past concerns about things like what Trump's tax and spending bill will bring as far as extra deficits, what sort of inflation might ultimately feed through from tariffs, what it might mean if the tensions between President Trump and Federal Reserve Chair Jay Powell break into the open. Those are the risk factors for treasuries there, but at the moment, investors are looking to the Fed and the strong expectation that the Fed will bite the bullet sooner rather than later and deliver rate cuts that will ease any difficulties that the bond market might otherwise have.
Much yippiness when you take a look at the longer end of JGBs?
There's definitely some yippiness there. Although, I mean, we'll see. It's been a bit of a whack-a-mole for the BOJ and for the Ministry of Finance. They managed to scrape through with the 20-year sale. Last week went off much more easily than the prior month. Sale, so we'll see how the 10 and the 30-year go this week. There is a lot of concern. It probably helps the JGB outlook that for the moment the US Treasuries market looks like it's in a decent place. So if that continues to be the place, if we don't see any too much upward pressure coming across from the US market, then they might scrape through. But there'll be a fair bit of nerves for both of those auctions. That's tomorrow and then later on in the week.
Garfield Reynolds, always good to have you with us. He leads our Markets Live Asia coverage. And of course, a reminder that we have live coverage of the ECB forum in Portugal on Tuesday. We'll hear from key monetary policymakers, including Fed Chair Jay Powell and the Bank of Japan's Kazuo Ueda. It will be moderated by Bloomberg TV's Francine Lacroix at 9:30 p.m. Hong Kong time. And coming up next, we speak with Japan's largest pharmaceutical wholesaler, Medipal, about their business outlook as Tokyo's top trade negotiators continue high-stakes talks in Washington. This is Bloomberg.
Welcome back to the circuit. This time, we're taking you to the frontier.
In the session, and of course we'll be watching the Japanese yen as well because it's become weaker against the US dollar. We're seeing a little bit of more of that rebound, but we're still in the 144 level against the greenback. You can see the Singapore Nikkei futures pointing to the upside right now of 0.8%. But what we'll be watching is a JGB space because we do have a 10 and 30-year auction on tap. Of course, we have seen a lot of volatility in this space. We do also have, in a few minutes, Japan industrial production numbers, so do stay with us. But let's talk a little bit about one company because Japan's biggest wholesaler of pharmaceuticals saying that it plans to evaluate cash deployment strategies to ensure better returns to shareholders. Medipal issued the rare statement last month saying it wants to increase return on equity to 9% by the 2027 fiscal year and improve its price-to-book value ratio. Let's get more on all of this with Toshihide Yoda, Senior Managing Director at Medipal. Toshihide, really good to have you here in the Tokyo studio. Before I get into the details of your financials, just tell us a little bit about your company because you were 3 pharmaceutical wholesalers that merged back in 2000. So what do you specialize on? Because you're sort of a distributor for major companies within Japan.
Thank you for your question. We are, of course, a pharmaceutical wholesaler, but we are trading actually everything in Japan. However, the primary market, like hypertension drug, such a kind of drug will going to the generic. So maybe the Japanese market bipolarized to the generic and specialty pharma. We have to make a strategy for bipolarized, right?
So in your financials, your price-to-book ratio has been below that one time. for the past 5 years or so. Your target right now is raising that. Do you have a time frame in mind?
Actually, we have the midterm plan year ending March 2027, and our target is by the end of the midterm plan, we are trying to reach to the PBR 1 times.
What prompted this sort of focus on your price to book ratio right now?
Firstly, we have to make a new business or profitable business. In addition to that, we have to reduce the net asset. We are selling investment shares. Historically, we have plenty of investment shares, and it's cross-holding. We are selling, and afterward, we make a share buyback and cancel our stock. So both sides, the increase the profit and reduce the asset. Then we are trying to reach PBR 1 times.
How confident are you when it comes to the profit goals, or do you think there might be some flexibility in needing to revise those?
We think about reach the 1 times because historically pharmaceutical wholesaler and including maybe similar company, we are thinking about a P&L statement only one. But balance sheet is quite important, and because of both strategy, P&L statement and balance sheet control, we believe reach our target to the PBR 1 times.
What are the plans when it comes to the use of cash in hand right now?
Actually, as I said, use the cash to share buyback, and also the important thing is diversify the profit resources, which means maybe the M&A strategy is quite important. Recently, we bought a food company, the kind of raw material of food. Such a kind of diversify of the business is quite important.
And those are the segments that you're still looking for more M&As?
Yes. Pharmaceutical wholesaling business, maybe margin will be squeezed in the future. Still is squeezing right now.
Why?
Because of the everybody sell same thing. Right? So user shift to the cheaper product, right? So margin will be shrinking. But now 3 companies dominate about Japanese pharmaceutical distribution business. So business exists, but margin has been squeezed. So we have to make a diversify. Of course, generic business is quite important. Also, specialty pharma business is quite important, and also the other business like food business. Such a kind of the product diversification is quite important to value up the company.
When it comes to food businesses, how exposed are you to geopolitical tensions? Of course, we talk about tariffs all the time. When it comes to pharmaceutical distribution, you are very much focused domestically, but if you are talking about raw materials and other things, does that expose you more to external vulnerabilities?
Actually, the still target is a domestic market. I said that raw material, our food is kind of gummy. Yeah, if you when you eat something to sticky thing, everything have our product, right? Such a kind of raw material food, and it's quite a basic food, but a stable market.
Oh, I see.
Right.
You're also in cosmetics, you're also in animal health as well. Do you see other segments that could grow faster without the squeezing margin that you talk about in pharmaceuticals?
Right. Especially animal health, animal pharmaceutical drug is quite important because of the companion animal or the pet will be increased also in Japan, and also this kind of area has no cap by the public insurance. That is quite important. Pharmaceutical business is quite big, but Japan covered by all public insurance means price has been capped.
I mean, I know very well how much you can spend on your dog, on your pet. So thank you so much, Toshihide Yoda, Senior Managing Director of Medipol, talking to us through the pharmaceutical business, especially when it comes to pets as well here in Japan. We do have breaking news for you at the moment. Japan industrial production gaining 0.5% for the May preliminary numbers, which is a smaller gain than was expected. Still a rebound from the previous month when it actually contracted more than 1%. The year-on-year number still, though, a contraction of 1.8% and also a bigger contraction than what economists has estimated. Of course, we do have really a dynamic variables here in Japan, including the auto tariffs hitting auto manufacturing, not to mention, of course, the chip sector continuing to grow. So we're seeing now the industrial production numbers growing 0.5%. Catch Japan Ahead every Monday at 8:40 a.m. if you're watching in Tokyo. Subscribers can watch live on the terminal using the TV Go function. This is Bloomberg.
You missed it on the opening trade.
What trade does is it meets a consumer demand. Consumer demand is not weakening. China supplies a little over 30% of what we eat, wear, and consume. That's unlikely to change anytime soon. I think that supply will find new homes potentially, but our reliance as a global economy on Chinese manufacturing is unlikely to change fundamentally anytime soon.
Don't miss the opening trade live every weekday.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Masayoshi Son has told SoftBank shareholders he plans to lead the company for another 10 years, but he's also revealed the outlines of a succession plan, saying he has several candidates in mind from within the group. For more, let's bring in our technology reporter, Min-Jung Lee. Min-Jung, 10 years is still a long time, but we're already talking about successors.
Yeah, it was a bit of a surprise that he spoke of his potential successors, but it was mostly in response to questions from shareholders who seemed a little bit worried about a future without Masa-san. And I think the key goal in saying that he does have a succession plan in place was basically to appease these shareholders who are a bit concerned. But like you mentioned, he did also make it clear that he wants to be around for another 10 years. So I think he will be here for us for the time being.
Clearly a long way down the track, but is there a list of potential successors?
Yeah, he did say he does have multiple people he has in mind within the group, but he didn't mention any names. He did give an example of how the mobile unit, SoftBank Corp, has been now succeeded by Miyakawa, and how he's doing a very good job in the position, which kind of raised questions about whether if he could be a potential successor. But for now, the understanding is that it was merely an example of how SoftBank does have a succession plan in place when it's needed, and it's possible for someone good to succeed Masa Son when the time comes. But at this stage, we don't really know who it can possibly be that could lead SoftBank Group when he does decide to step down. SoftBank did have some potential successors in the past, like Nikesh Arora, Marcelo Clore, but these folks have all left SoftBank for now, so we don't really know anyone who could potentially lead for now. So that's a big question.
Our technology reporter Min John Lee there. The market opens in Sydney, Seoul and Tokyo are next. This is Bloomberg.
In case you missed it on Balance of Power.
Administration officials have maintained today that the objective was solely to focus on Iran's nuclear capabilities, that this objective was not regime change. But, sir, even if it wasn't the objective, could that still be the end result, and how?
I think regime change has to be the objective because the Ayatollahs are never going to give up their pursuit of nuclear weapons. They have to be forced out of power. That's the only shot we have at really lasting peace and security in the Middle East. And a strike like this, and potentially others, can disrupt the regime, can destabilize it. Look at the choice that the top military officials and key Ayatollahs now have to face after the U.S. attack. Now they have to make a choice. Do they want to take on a second military adversary in the form of the United States? They may well do it, but they would be making a big mistake from the point of view of regime survival.
Don't miss Balance of Power live every weekday.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
The capitalist system is the best system in the world. There isn't another one that works as well.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Wall Street used to be a place. Now it's more of an idea. I hope you survived the day.
I did. It was a busy day.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens and what could turn out to be a positive day for risk assets across Asia. Heidi, of course, we have more optimism about potential trade deals between the United States and other trading partners, but also with that fragile trade truce with China, potentially we could see the June manufacturing PMI turn positive.
Yeah, not a great deal of detail when it comes to expectations for this trade deal, but President Trump saying that he doesn't see the need to extend that deadline, which of course is creeping up. But Sherry, still a great deal of uncertainty. We're sort of less focused when it comes to Middle East politics and back to, I guess, the fundamentals of what happens with trade, tariffs, the broader macroeconomy, but also taking a look ahead at earnings as well.
Yeah, we are just weeks away from the earnings season, of course, to get started in the U.S. as we continue to watch, as you mentioned, Heidi, oil prices as well with Middle East tensions easing. Take a look at the open in Japan because we're seeing that upside for the Nikkei of 1% and extending already 4 sessions of gains for Japanese stocks. We're seeing a little bit more upside for the Japanese yen against the U.S. dollar as well at that 144 level. As we keep an eye on JGBs, of course, we do have a 10 and 30-year auction this week to contend with. We have seen a lot of volatility, so do keep an eye on the JGB space. We are also watching industrial production because we got those numbers for Japan just earlier today, and we saw that disappointing to the downside. We're talking about the month-to-month number barely rising year-on-year, actually contracting. Sort of a similar picture what we're seeing in South Korea. Take a look at how the Kospi is opening at the moment because we had seen pressure for the Kospi, for the Korean won, and now for industrial production for the month of May, also contraction in this economy. Of course, those tariffs still in place when it comes to the auto sector. Very important for the Korean economy, very important for the Japanese economy. But you can see in today's session, at least, we're seeing gains of 0.6%, while the Korean won is holding steady, Heidi.
Take a look at what we're watching when it comes to Australia because we are looking at like a little bit of an upside today after we saw that retreat in the previous session away from those record highs. We saw that drag from banking stocks in particular, but at the moment we're seeing a bit of upside, 0.2% there when it comes to trading for Australian stocks after 2 days of decline. So really playing catch up with the gains that we saw on Wall Street to those record highs. The Aussie dollar also seeing a little bit more further progress at 65.32, looking alongside the Kiwi to clock in some pretty good monthly gains, but that very much depends going forward on the trajectory for dollar weakness, right? But we're also watching treasuries. We did see futures just slumping after Trump threatened more tariffs on Canada. The concerns of higher tariffs and the ability to push up US inflation is at play there. But of course, so much of this is built around these growing expectations around Fed rate cuts, Sherry.
Let's bring in Hartman Issel, head of APAC Equities and Credit at UBS Wealth Management. Hartman, always good to have you with us. It seems that equity markets, at least, are finding any excuse to go higher from this point. We have seen Wall Street again reaching a record high. Will that optimism translate into the Asian session?
Normally, would expect that. Yeah, although I would also comment maybe that for the near term, maybe till the end of the year, we think, especially if we start at the S&P, right, it's come back since the lows in April quite a lot, so we think probably a bit time to take a pause.